Hey, good morning, everybody. Welcome to this Wednesday, September 20th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we take a look at futures, get ready for the Fed meeting, which the Fed policy statement will be released at 2 p.m. this afternoon. So talk a little bit about that and just take a look at some charts as we get ready for the trading day ahead. Going to jump right in, talk a little bit about futures as we take a look at what happened yesterday. So right now we've got futures up pretty good. Dow, S&P, NASDAQ all up roughly about 1/3 of 1%. We're seeing a little bit more strength this morning in the small caps. The IWM, I think, was up about 0.5%. So getting started on the right foot, but we've seen this before with movement to the downside. A lot of times what we see with the stock market is gravitation to a key area right before the Fed meets, right as the Fed's meeting. I'm not quite sure what that level would be on the S&P 500, though, at this point, unless, I don't know. I'm really not seeing anything just looking at the chart. But the bond market, the 10-year treasury yield is sitting at a critical level, right at that 4.33, 4.35% area. Today, it is down. It's sitting at 4.34% right now. So this is, excuse me. This is just a few hours before the big report. And 434, I mean, which way we go on the yield could have a big impact on stock prices in the near term. Again, I don't think it's going to have a big impact long term unless we see the yields go up above 5%. But I do think short term with the market, we've seen the VIX picking up a little bit the last couple of days, so a little bit more nervousness. And of course, everyone's talking about the 10-year treasury yield. So if it does pop, then you're probably going to see a knee-jerk reaction in the equity market. However, if maybe the Fed gives us a little positive surprise in terms of, some of their language this afternoon, in which case some of the worst selling could be behind us and we might see the market, take right back off again. Really difficult to say, as I've been saying the past really couple months, trying to predict the short term, whether we go up today or down today, what happens between 2 and 4 o'clock this afternoon. I don't know. We're range bound. Honestly, I could make an argument in either direction. I could, fully support the bulls and say, hey, we're already down quite a bit in September. Let's get the Fed behind us. And then we're ready to go, start to talk about earnings season. But then on the bearish side, I can talk about history. Last 10 days of September, historically, the worst 10-day period of the year, or certainly one of the maybe two worst. So we've got that still to go. I mean, it is only September 20th, so we are just literally embarking on this bearish period. And you can point to a lot of the areas of the market trading below key moving averages and saying, hey, short-term bears are in control. So I could make arguments both ways. That's not helpful. But what it tells me is that the chop that we've been experiencing could continue for a while. So honestly, I don't know where we're going here in the short term. I am still, everything I see points to higher prices in the fourth quarter. I have no signals that I can think of that tell me that this market is going lower for a significant period of time. Now, as I look here at the recap from yesterday, one thing that I'll point out is that the AD lines have been going down. And even when we've had bounces, you can see the bounce in late August on the Dow. Not much of a bounce in the AD line. Same goes with the S&P 500. We had a pretty nice bounce at the end of August. Not really a lot going on in that AD line. And then as we just start to roll over, we set a new recent low in the AD line. So if I was going to point out one thing that I think is at least worthy of mention that we need to keep an eye on, I would say it's the AD lines. Because what this is telling us, if you're familiar with how the AD is calculated, it's telling us that the market is tending to not do very well in the afternoon. And so I just don't think we have the buyers coming in just yet. When these AD lines pick up and the price action starts going up, that's going to be a pretty solid indication that we may have our next uptrend on our hands. Till we see that, it's hard to really feel like any kind of a movement to the upside is sustainable at this point in time. And again, it's the end of September, so it's kind of what we would expect. But yesterday, the Dow Jones was down about 0.3%, S&P down 0.2, NASDAQ down 0.2, mid caps down 0.2, small caps, the IWM down about 0.4. So again, just a slight, a little bit more lagging, I guess, in that area of the market in the small cap arena. Transports, and by the way, we closed on the IWM 181.68. We're down that 179, 182 area of support. And while I'm thinking about it, I showed this to members, or maybe I showed it on the show yesterday. I can't remember. But one thing you can do on these charts is if you go down below and you click on price labels, and I don't usually use price labels. I normally find support by drawing support lines. But if you use price labels in the chart and update, you'll see some of the key lows that have printed throughout the last year. And if I look more recently, I mean, here was sideways consolidation. We broke out of that, and we haven't gone back down below the breakout level since. That breakout level was at about 170. Well, that's actually closes. Let's do a candlestick, because I think you'll see even higher levels. All right, so here, if we use candlesticks, the high was 179.28. Here was an open at 179.13. So that 179 level was really the ceiling during this sideways consolidation period. And then you can see the big breakout here in terms of price action. And those were some pretty solid candles telling me that, hey, that was a big breakout, meaning 179, 179.28, right in this area, could be some pretty significant resistance. Even this 180.03 level, this was an intraday high. A lot of traders like to use intraday prices. I tend to stick with opens and closes. Anyway, here was the big breakout. When we went back down, look at where the lows were: 180.05, 180.72, 181.61. Now, it didn't show yesterday because we don't know where the bottom is just yet. But yesterday's low, 181.07. So we're getting down close to this 179, 180 prior resistance, which should hold as support. And it has on a few different occasions. Does it hold this time? Fed meeting coming up this afternoon. I mean, if ever the bears maybe could have a catalyst, this could be one. So I don't think we break down on the IWM, but a move below 179, 180, that area, especially a close below 179, I think you have to be much more cautious in the near term, because I mean, that doesn't mean that we don't go higher, but it certainly could bring some of these other support levels into play. And if you're trading, you don't want to lose what I consider to be a significant support area and make excuse and say, well, still holding these down here, let's hold on to those. Then you go down, test those. Then you go over here, well, 160 still good support, which, by the way, if you look at a weekly chart on the IWM and stretch it out, actually it's a pretty good area to stretch out. Here was the high pre-pandemic, just above 160. Came down, broke out above 160. And so we talk about the 160 support. I'm not talking about on that daily chart. That would be major support on the weekly chart. That would be an eye opener. Now, we're still 11, 12% away from that support level, and I don't believe we're going down there. But if you want to talk about a major support level from a long-term perspective, that's it on the IWM. Let me go back to where we were. All right, transports down 0.6%. So transports really hurting the overall market, keeping a lid on some areas, especially industrials. I saw industrials down around 103, 104 at one point yesterday. I don't know where they finished. But industrials, I mean, I'm still fine in that area. And I do believe industrials are going to follow their seasonality pattern. I think we'll see it again in the fourth quarter, but we're not quite there yet. Got, like I said, another 10-day window or a bridge to get us to October and perhaps another pre-earnings run up. Energy. So if we're looking at the worst performing groups yesterday, I know intraday, all 11 groups were down. I think by the end of the day, I know communication services went positive. I think there was one other group, maybe healthcare, that went positive. But the worst performing groups on a down day, and I look at this and I'm like, okay, consumer discretionary, technology, communication services. And then I look, and here are your three worst: energy, utilities, real estate. Two defensive groups and what I consider a neutral group. Materials and energy I consider to be neutral groups. They're not really offensive. They're not defensive. I see energy and materials go up and down markets. I see them go up and up markets. There's really no rhyme or reason. And they can move a lot based on what's going on around the world. Geopolitical concerns might have nothing to do with our economy. Energy, crude oil prices, commodity prices start going up, crude starts rising. That's generally a pretty good indicator that the energy group's going to rise. If crude oil prices top and go back down, energy is likely to roll over and go back down. So it's just not something that typically is tied as closely to the economy and to interest rates and that sort of thing. So that's why I refer to them as more of a neutral group, energy along with materials. But two defensive groups, as we're going down, again, the money is not really rotating into defensive groups on a relative basis. It's actually moving out of defensive groups. I showed this on yesterday's show. You can go back and look right toward the end of the show. I pulled up relative strength charts on the aggressive groups and then relative strength charts on the defensive groups. Defensive groups are still going down on a relative basis. Aggressive groups still have their uptrends. So, and that's a really big factor in trying to determine whether the stock market truly is about to go lower, because Wall Street's pretty smart and they see it a lot of times before we see it, whether they tell us on CNBC or not. There, you can see it with their money. Can't always see it with their lips, but you can see it with their money. And the charts are not showing it. So it's hard for me to get bearish. Again, back in July, we talked about a period that was going to be rough. And typically summertime, July 17th to the end of September, that's your worst historical period of the year. When we look, we step back and look big picture. That's a little over 2 months. And that's when the market tends to produce below average returns. And it's doing it again here in 2023. So we know all of that. Let's get through September. Let's get through all this chop, this transition, this phase that we're in. And then let's see which way we break. That's going to be really the telltale sign. Steel had a pretty good day yesterday, up over 2%. That's part of the material group. And that was after a recent breakdown below 450. Still trading well up above the June low, though. So again, this is an area that's just part of the chop that we've been seeing. Recreational services has actually been in a downtrend for a while. This is a group that I'm actually looking for some strength in the fourth quarter. It was up yesterday, up about 0.9%. First thing it's got to do, though, is get through that 20-day moving average. It looks like that PPO is beginning to flatten, even though prices have been going down. So maybe, just maybe, we're at or very close to the low on recreational services. Again, I'm not going to be convinced or even start to be convinced until we can recapture that 20-day moving average. Airlines also up yesterday about 0.7%. This group looks even worse than recreational services, though. It gave back all of those early summer gains where we went up and posted that high in July, up at over 200. The index now is back at 149.67. It's actually dropped 25% in just the past little over 2 months. But it also went from 140, 150 to 200, from 150 to 200 in about 6 weeks. So it's just been a really volatile group. I see the economy strengthening later. I believe airlines are going to bounce back. But quite honestly, I've been saying that for the last month, and we haven't seen it. So again, like recreational services, if you need to see it first, you want confirmation, it's got to get through that 20-day moving average. That's the first step. It's already failed there twice, as you can see on the chart, both times in August, and it's still considerably below that 20-day. PPO, new lows, so it's not really showing us anything there yet of a subsequent move to the upside. So we got to wait for it. We got to see it. And right now, our airline's not quite there. 10-year Treasury yield. So big news, of course, today is the Fed meeting. The announcement will be out at 2 p.m. this afternoon. And when let's get this update here. Yeah, we had closed at 437 yesterday. We're down 4 basis points today, 432, 432 and a half. So we'll see which way we go. After 2 o'clock, I mean, all bets are off. Usually the 2 hours after a Fed announcement can be two of the wildest hours you'll ever see in the market. And, you know, the initial move is usually not the move that the market's going to actually take. Sometimes you have a couple of fake outs before you really start to settle in, maybe from 3 to 4 Eastern. So you got to be careful. You can get whipsawed. You got to, if you're holding like ETFs, you know, long, personally, for me, I'm probably just going to sit through it and just see what happens. I'm not going to trade. But it can get a little dicey, especially for those that like to chase, because you might see the announcement come out and the market really just take off to the upside. And then you're like, oh, here we go. So you jump in on the long side. Next thing you know, 10 or 15 minutes later, you're at a new low. And then you're sitting there, okay, what do I do with this stock that's now down 7% in 15 minutes? It gets a little dicey. Some traders love that volatility. Personally, I can't stand it. I don't like to not have any more control over my portfolio than that, where it's just going up and down like a yo-yo. That's why for me, sticking with ETFs probably makes a little bit more sense, because even, you know, I don't expect the major indices to be up or down more than 2 or 3%. I can handle that, but it's getting into individual stocks and seeing them go up 5-10% or down 5-10% in minutes that can drive me crazy. Anyway, 10-year Treasury yield still obviously in an uptrend, but this is major resistance. 433 right here in October of last year. 436 is what we saw in August, just last month. And yesterday we closed at 437 or 436.5. So right there where we were in August. What happens after 2 o'clock today? I don't know. We're going to find out together later. All right. S&P 500. I mean, just more and more chop. I mean, what do we expect after the Fed? Where are we going to go? Well, downside, I think we probably have 43.05 to 43.35. I think that's your support zone. Upside 4,600. We're sitting at 44.44. Couldn't be much more in the middle than where we are right now. Which way do we go? Pick one. I flip a coin. I just don't know. I did like the recovery yesterday on the S&P. We had put in a tail that was below the early September low, came back up and held it. That's good in the short term, but is it really meaningful on the daily or weekly chart? Not at all. So we'll see. Can we build off of that? We got futures up this morning. Can we continue to build off of it? I don't know. One thing I like to do is I just go into stock charts. And if you go to symbol summary, you can get pre-market prices. So a lot of times if I'm looking at CNBC, it's 10-minute delay. So I can come right in here and get the exact where we're trading right now. So diamonds right now up almost 0.4%. Spider, pretty much the same. The NASDAQ 100 QQQ, slightly below the other two. And then we've got the IWM, which is still up about 0.5%, doing a little bit better than the others. But really, the open, especially on Fed day, the open really means little. It's really what happens after 2 o'clock today. That's going to grab headlines and grab all of our attention. All right, let's keep moving on. Got a few things I want to talk about here. NDX, pretty much the same as the S&P 500. You can see nice little recovery there. Small caps, we recovered off the low, but wasn't nearly as strong as we saw in the other indices. The IWM was actually outperforming both the Spider and the QQQ earlier in the session, but we're trailing it by the end of the day. So the intraday relationship definitely weakened yesterday. Looking at the transports also really struggled, came back a little bit at the close, but still nothing on the PPO, nothing in terms of price action yet, price support that tells me that we're at a bottom on the transports. So I still think, if the market's weak, this is definitely an index. I don't see a floor until first floor, I would say, is maybe just below 15,000. Maybe a bigger one would come down at around 14.5. But otherwise, I'm really not seeing anything. It's hard to just jump in right here and say, oh, it's going to go higher in the fourth quarter. Well, it may, but certainly next week or two, we may see lower prices there. All right, for those of you that enjoy the chart of the day that we do at Earnings Beats, subscribe. It's pretty simple. Go over to earningsbeats.com. You can scroll down. Actually, you scroll down right here. You have a name, email address. That's all it takes. Just put it in there. Hit that subscribe button. We'll get you set up. We do these Monday, Wednesday, and Friday. We're normally out around 8:30 in the morning. I was actually a little late this morning getting it to Aaron, who publishes it for us. So maybe you got it a little bit later this morning, or maybe it's still not out. I don't know. But usually we try to publish it around 8:30, which is about an hour before the market opens. So make sure you sign up for this. If we do a free event, we send the room instructions out to anybody that's subscribed. So that's another really big reason to be part of this Earnings Beats Digest community, so that you can be invited to many of our free events. And we do plenty of them throughout the year, trying to give back to the community. Also, today at 10 a.m., we've got a live trading room. I can tell you it's probably going to be a boring trading room today. I'm not going to lie. It's kind of hard to do a whole lot of trading just a couple hours before the Fed announcement. We'll talk about some things, maybe watch lists, setups, things like that, but I doubt that I will trade anything today, just simply based on the fact that we have the Fed meeting coming up at 2:00. Taking positions ahead of that, or even just after that, can be, I'm not going to say financial suicide. That might be a little bit too much drama, but it can be very risky. You can lose quite a bit of money in a fairly short period of time. You can make a lot. So if you got that gambler mentality where, hey, I'm willing to risk it if I can make it, then maybe today's your kind of day. It's not my kind of day. I can be aggressive, but I've just come to realize how volatile the action can be after 2:00. But anyway, what we'll do is we'll talk a little bit about strategy. We'll talk about building watch lists, those types of things, which are really important as a trader. It's not always about placing a trade. It's about planning. It's about looking at the market. It's about seeing, okay, if the market takes out this level, things start to look a little bit better. Or if this intermarket relationship starts to turn back up, or it breaks out, that starts to give you more confidence to go on the long side. If they're doing the opposite and you're thinking about going long, you might hesitate. So there are a lot of things that we can do, and that'll be probably the focus of the trading room today. But any member at Earnings Beats can come in and join us. So even 30-day free trial. If you want to just try us out for 30 days, it'd be a great time, taking us right into the start of earnings season next month. And we also have a portfolio draft coming up, our model ETF portfolio, which has been really good for about the last year and a half. That'll be coming up in October. So you'll be around for that. There's a lot of different reasons to take out a 30-day trial right now. Anyhow, click on that to join and come in and check out our trading room. And by the way, if you do sign up for a 30-day trial, you'll get 30 days, which means you're going to have 5 trading rooms. We do this every Wednesday. So during your free trial, there'll be 5 Wednesdays to come in to the live trading room. Anyhow, let's keep moving. Let's take a look at the actual chart of the day for today. Just sent it out to members just a little bit, or to EB Digest subscribers just a little bit ago. This is a stock that I've mentioned. I actually bought it and then I sold it because it closed down below 13. But this 1250 to 13 area, if the market were to rebound this afternoon, I don't know, if the Fed says, maybe the Fed just doesn't say anything different, and maybe the market feels good about that, we could see a nice big rally. And if we do, this is a stock I think poised to make a big rally. It's been one of the leading stocks. It pulled back recently here, as you can see, but prior to that, it had started to show some real leadership characteristics relative to one of the hottest groups in the market, the internet space. I don't know if you noticed, but if you go down here, internet relative to the S&P 500, even though the market's been going down, internets, I don't think, have broken out on an absolute basis, but they are outperforming on a relative basis. And for those that say, hey, we're going into a recession means that earnings drop, sometimes significantly. If you are worried about earnings falling, the internet group, which is a very aggressive group, their earnings can explode, but they also can drop very rapidly. If you're worried about a recession, would we be seeing internet stocks on a relative basis continuing to outperform the S&P 500? Would we be seeing all the technology area, the consumer discretionary and communication services clearly remaining in uptrends relative to the S&P 500? Would we be seeing all the defensive groups underperforming? I mean, these are the signals that are telling me that, okay, I'll recognize short-term risk here in the market, but I'm not changing my tune as far as what I expect in the fourth quarter. It's not what's going on the surface. It's what's going on under the surface. And unfortunately, that's why I don't like the media, because they don't talk about the under the surface. They talk about on the surface and then try to use it to manipulate folks, to scare. And I'm just not into that. And quite honestly, I started trading better when I ignored them. So that's the reason I do it, is it actually improved my trading a lot to stop getting fed all of that, confusing me in the back of my head. Because I'll look at things and say, well, it looks like the market's ready to go higher. And then you sit there and you listen to expert after expert telling you it's going lower, and it clouds your vision. Right now, my only vision is on the charts. So anyway, UPWK, look at this move up when it gapped up with its earnings report back at the beginning of August. Look at the volume that came in. I mean, we're talking about 22 million shares. Look at the last 6 months. I mean, going over 5 million shares, that's probably only happened to maybe half a dozen times in 6 months, maybe on average once a month. 5 million shares, 22 million shares. Not only that, but it gapped up. Most gaps fill, meaning that you gap up and then you go back down to the prior day's close. That's what a gap fill is. When I see a stock on this kind of volume, first of all, gap up, because we know when everybody's buying, who's selling those initial shares? I mean, if it's great earnings, there might be some traders selling into the strength, but for the most part, it's going to be market makers providing liquidity, meaning that they're taking short positions at the open, which, by the way, is why most gaps fill, because market makers are on the short side on that gap up. In this case, there was so much demand. We opened at 13, and by the next day, we were at 1588. So not only did we get the gap up, but then even after market makers are committing their capital on the short side, we explode right through and keep moving higher, forcing market makers to cover. That's what triggers these moves to the upside. So once we finally reached a peak where the buying demand slowed, you can see we pulled back, went back up, got this double top. So clearly resistance is now established right up under $16. And here is your support. Yesterday, we went a little bit below 1250, but came back up, closed at 1264. 1250 to $13 is key. If the market goes higher from here, this is a stock I think that could be 1550 in relatively short order. I think it's going to go back up. Now, the downside is if it fails to hold here, I would be out quickly, because I don't want to hold if it goes back down to $10, the gap support down there. I mean, I'll be down 20% if I hold all the way down to $10. So I'm going to keep a fairly tight stop. If you want to trade this, definitely think about any close below 1250, maybe any move below yesterday's low, 1234. Maybe keep that in mind as possible, reason to get out. But I like the risk reward here, because I do think you can manage your risk to the downside, but to the upside, I mean, I could see $3, which would be 25% move from where we are right now. All right. That is just about it. It's 9:29. Yesterday, I showed you the relative strength of the sectors. What I want to do is show you the relative strength of the industry groups to wrap the show up today. This is going back 1 month. This is our relative strength industry group chart list that we have provided to all of our annual members at Earnings Beats. Anybody who's an annual member has this chart list either to view, or if they're a member at Stock Charts, an extra member or above, they can download it right into their account. And once you get it, you got it. I mean, unless industry groups change, this is, one-time thing. Or you can set it up yourself, but it does take a while to set it up. So it's just a little perk that we give our annual members. But here, if you set this chart list up under summary form, it will tell you which group has outperformed the S&P 500 the most, or which group has underperformed the S&P 500 the most. And if I'm looking at what's been outperforming, first of all, autos, which I consider to be one of the more aggressive groups, automobiles. Again, recession ahead? I don't know. When I'm looking at automobiles, I mean, we do have one defensive group here, the mortgage REITs. But other than that, I mean, we got defense, or we got aggressive, we got neutral. Here's aggressive, here's aggressive, here's aggressive, here's aggressive, here's aggressive. Look at the financials over the last month. We got 3 different financial groups. Well, let's take a look at the first one here. This is your reinsurance group. Look at the relative strength here of this group breaking out right now. Let's go and take a look at specialty finance, breaking to a, I don't know, maybe a 1.5 year relative high. Looks really good. How about the full line insurance? We were strong back at the beginning of the year. We're really weak in Q1, and now we're bouncing back, trending higher again. That group's strengthening, certainly over the last month. Another financial group right down here, insurance brokers, pointing straight up. How about another one? This is the 5th group in the top, 5, 8, 12. Almost half of the top dozen industry groups in the last month are financials. Again, who's talking about financials? Probably not too many folks. But here's your property and casualty group. Look at the last 3 months, really, 2.5 months. Huge move back to the upside. Not quite out of the woods yet. I'd like to see this go positive, the relative PPO. I'd like to get above the 50. But we're definitely heading in the right direction. My point is here, the groups that are moving back to the upside, I mean, if you start thinking about a recession, would you want to start pouring your money into the financials? Usually, I mean, most folks don't realize this, but financials tend to do better when rates are rising. I mean, if you think that we're going into a recession, rates are going to come down, I'm not sure I'd be jumping into the financials. But anyway, that's just another look at, some of the things that we look at. And this is part really what I'm thinking about in terms of preparing for trading. You need to see where's that money rotating? Because if you can get in early on one of these big moves in one of these areas, and you find stocks that are leaders within this space, that can give you some really good candidates for trading when the market does improve. And if we continue to see that money rotating towards financials. Actually, one more. Let's go ahead and look at that financial relative chart. So here we are. And here you can see the financials breaking back above the 20, moving to about a 4.5 month relative high. Here is the absolute price chart. Now, the XLF hasn't broken out above 36, but while the market's been going down, the XLF's actually been going up. And that's what's triggering this relative strength. So we're starting to see, and that's what I talked about in September, is to see whether or not we're starting to see rotation towards some of the more value-oriented areas. Energy, that's a yes. Financials, that's a yes. Industrials, not so much. I'm waiting for this one. You can see, I mean, we're still above the May low, but last month or so, it's actually been going the other way. Took a turn yesterday back to the upside. I'd like to see that continue. But these are the things that I would be continuing to watch. Not so much. Everybody wants to focus on the S&P 500 or whether this support level holds or that support. And that's all fine and dandy. But what's taking place underneath the surface? To me, that's just as critical, if not more critical. And unfortunately, we just don't hear about it enough. But you will hear about it here because I talk about it a lot. Anyway, let's see what's going on with the market. We just opened, and it is Fed day. We're a little bit up, but down from where pre-market was. You can see NASDAQ now up only a little more than 0.1%. I think we were at 3.5 tenths. It was like 0.35% pre-market, now it's 0.13. Small caps, though, a little bit better than where we were. They were just shy of 1.5%. Now it's a little bit more, although that's the S&P 600 small cap. IWM, it's still around the same 0.47. IWM and that small cap index don't have the same components. IWM much more diversified, 2,000 stocks versus 600 in the small cap. And the IWM, a lot, there have been questions like, what are some areas maybe to kind of watch that would kind of give us a clue about the IWM. One is the regional banks. There's a lot of small banks, small to mid-sized banks in the IWM. And you can see this has been a weight on the group for a while. It's up today, which is part of the reason why we're seeing the IWM. There's also a lot of small biotechs. So the diversified XBI is an area also to watch. You can see breaking down slightly below the August low. These are a couple of areas. The XLI. Now, the XLI is large cap industrials. I had a question that came in and was wondering, is the XLI, the biggest thing correlated to the IWM? And my answer would be no, because the XLI, this is, a lot of the large cap industrials are really what triggers this. I haven't looked at any kind of correlation, but I would look at more something like the PSCI, which is a small cap industrial ETF. And it's been going down, struggling. We just saw the XLI, which was up today. The PSCI is down 4 cents. So that's actually putting a little bit more pressure on the IWM. Anyway, just a couple of things. Member had asked about it. I wanted to point out. All right, so that's it. Fed day. It's let's see, 9:30. So we got 4.5 hours. I want to wish everybody the best of luck. Honestly, flip a coin. I believe what the Fed is going to say is that they're not raising rates today. I think they're going to say they're going to remain vigilant. They may continue to raise rates, that there's still members on the committee that think, hey, we may need to keep raising rates, that they're going to continue to watch the data, and that they want to see inflation continue to move down toward their target level. I mean, that's what I would expect. Now, Fed Chief Powell has not always said what I've expected. So if he comes out with something different at 2:00, I don't know what to tell you. I'm not a big fan of this Fed just because I don't think they're quite as transparent as some of the prior Feds. And I think the market has lost confidence in this Fed as well. So let's see what happens at 2:00. I don't know what else to say. Have a great day, everybody. Happy trading.